Signet. Before I continue, I wanted to ask you guys who already worked with Signet, or at least who knows the company, who analyzed the company pluses, and who doesn't know put minuses, and who knows so plus minus. Okay, Jonas doesn't know, Max knows, Dory knows. Okay, Nona, yeah, okay, great. Okay, 50-50, I'd say. It's general. Okay, it would be interesting for you. And okay, you probably read the last report, I hope. Okay, but we'll check it now in a second. Okay, let's go through value line. Value line was prepared before their last earnings call. So that's why information which is right here in this report is not reflecting the last report. Okay, so after we look at this specific report, we're going to look at their actual last quarter report, and we'll try to understand, is it something bad happening within the company and we have to stay away from that, or maybe it's a great bargain. Okay. Now, in order to understand health of the company, let's have a look at certain parameters. First of all, we're going to look, okay, let's see here, first of all, P ratio is 8.4, and as I told you before, P ratio for index is nearly 25, so it means that this specific company is valued 3 times less, so it's cheaper than market in 3 times. Okay, so people pay in general for companies in index 3 times more than they would pay for this specific company. And at the moment, price is $52.67, so it means that it's another 20%, nearly 20% drop. Okay, so which is, I think the PE should be low as well. Now, timeliness is 3, safety is 3, beta 105, so it's like moving usually in the same volatility as market. But look, value line sees this company trading between $90 and $135 within the next 3 to 5 years. With the current share price of $52, it's quite a good move, okay? And it sees that this company might move about from 12 to 23% annually. And if we add another 20%, which dropped now, so it's extra like 65% would be here and 140 here. So based on value line prediction, this company has a pretty good growth potential, price growth potential. Okay, we'll look at the after earnings potential. Now, the company itself was established in 1950, so it's quite a while already in the market, and it started trading on kind of on New York Stock Exchange in the worst time in 2008. Okay, so but it's went public. Now, let's have a look at sales level. We're going to look at sales and earnings for the share, and also we're going to look at this for the company as a whole. Starting from 2008, we see $39, $38, so it was a slight drop in the first year, like it was a bad time. But then look at this: $39, $43, $48, $52, $71, $82, $94. This year they are planning to close $105 and then $108 and $120. So what do you see, guys? Constant growth, right? So the sales level per share is growing every year, okay, non-stop. Now, if we look at sales level for the company as a whole, we can see pretty the same picture, except 1 year. Okay, look at this: 3.2 billion, 3.4 billion, 3.7 billion, 3.9, 4.2, 5.7, 6.5, and 6.4. Look at this, interesting, right? So in 2015, sorry, it was $6.5 billion in sales, and here $6.4 billion in sales. So company sold less product as a company, but when you look per share, you can see that it was $82 per share, and then it was $94 per share. So it's like strange. If you take in calculate the sales for the company as a whole, sales going down, but per share going up. And I wanted to ask you guys who recently went through education, why do you think this is happening? How can it be when sales is general going down, but per share they're going up? Who can answer it, guys? Nick, Gina, guys, what can you say? Correct, Nick. Correct, absolutely. You're both right. So, and look at this here. You can see common share outstanding in this line. You see, they in 2015 they had 79 million shares, and now they have in 2016 they have 68 million shares. And it's actually very good indicators. Look at them. They had always bought their shares. They were kind of buying them constantly, you know. So and it's becoming less and less. But look, it's interesting. They practically didn't buy shares starting from 2012 to 2015. And in 2015, they bought quite a lot of shares. And if you look at the price level, you will see that at that moment, shares went from $150 to nearly $72. So they decided to buy quite a lot of shares when the share price dropped to 72 bucks. Now, I want to ask you, do you think it was a good decision? Is it a good thing to do, to buy shares of your company? And is it a good time to buy it this when the share dropped? Or they had to buy it when the share price was higher? Did they do a right job or not? What do you think, guys? Yeah, absolutely. So, and it's actually very good because I know Hewlett Packard, I looked at them, they're awful with that. Like at least they were awful. They would buy shares at the peak of the price. When the prices are so high, they would buy because they want to pump up earnings. They want to show more earnings per share. They want to show the growth. And they would buy shares when the share price of Hewlett Packard was high. These guys, they didn't buy shares when the prices were high, and they start buying when it's dropped after. So using the same amount of money, they could buy twice as much of shares as before. And I presume you understand that it is a good thing to do. Okay, so and they are planning to do it in the future as well. Look, they are planning to have 60 million shares this year, then 58 and 55. Okay, so that's kind of stuff. All right, so we understood that. So that company had less sales during last year. So it's kind of a minus for this specific company, okay? But per share, it was growing. We invest in share, remember? So for you, important how much money you're making per share, okay? Because you're not owning the whole company. All right, so the next one, let's have a look at earnings per share. Again, when they went to the market, they had loss. I don't know, was that loss related to the 2008 market crash, or was it related to the IPO of the company, because it's quite costly process, and a lot of companies, they spend a lot of money when they go into IPO. But look, after that, very nice growth: 1.9, 2.3, 3.7, 4.3, 4.5, 5.6, 6.8, 7.4. And again, this year they anticipated the drop in earnings, and they wanted, like, they're planning to make $7.1 in earnings. Okay, actually, the company itself was saying that they're going to make between $7.1 to $7.9. So 7.1 was their lower level. Value line, they're usually conservative. So here they put the lowest kind of edge of the bracket, okay, which company presented itself. But then the company planning to grow 7.3, 7.5. Okay, you can see that. All right, so company pays dividends. We can see in dividends constantly growing, so which is a good thing. Roughly it is about maybe 2.5% based on the drop which happened now. Okay, again, if we look at the earnings net profit per share, we'll notice that as well the company was growing since 2009. 164, 200 million, 320, 350, 360, 450, 540, 570. Okay, that's the interesting thing which I wanted to point you. Look, they had less sales, so they had 6.577 billion in sales, and then 6.4. So they had 150 million in sales less here. But at the same time, the company made more money. So instead of making 5 $547 million, they made $571 million. So they made about $25 million more. So do you think it is a good thing? What would you prefer, to sell more but earn less, or to sell less and earn more? I presume for us it's more important how much money you actually can put. Yeah, correct, Ham. Because for us it's more important how much money we put in our pocket. Okay, so and that's a good thing. So it means that the company earnings growing faster than company sales. But then when I looked at the future, I actually was a bit disappointed, because look, this year they have a drop, 460 millions, and then again 460 millions, and here it's even 450 millions. I don't know if it is some kind of misprint, because sometimes Value Line makes mistakes on that, but maybe that's what they see. Or maybe Value Line decided not to do any prediction regarding their earnings, because here they're showing that their sales level is going up, but their earnings are going to stay flat, which is strange, right? So in this particular case, based on their history. Another thing so that's kind of definitely not a good sign. So we have to pay attention to this area when we evaluate the company. Now, another thing which I wanted to point is cash flow. So how much cash company generate, because we remember that sometimes company make zero money, but they generate plenty of cash, because they put a lot of expenses related to amortization, for example, writing of goodwill, and it's not cash loss. Okay, cash still stays in the company, and we can see here that cash inflow is always higher than their earnings. So, for example, if you take here 6.8 and $9, it's like nearly 50% higher. So if here it's $7.4 and that nearly $11 cash flow. So it's actually a good thing, and then they're going to continue the same level. So a company can generate cash in a pretty good volume. So it's an advantage. Now, then we can see that they have, if we look at debt level, long-term debt, we can see that they had some debt in 2009, then they had zero debt, and then they got $1.3 billion in debt, and then they start paying it off. So you can see it's 1.36 billion, then 1.32, then 1.31. Okay, and look at this, they are planning to have only 700 million here, and we're going to cover it in this case. Look, if you look at this specific Value Line report, why do you think they took this debt? Any suggestions? Yeah, correct, Nick. So probably not even Zale, maybe something else, but maybe Zale. So if you look a bit higher, look at this number of stores. You see number of stores, and if you look before, they had 180, like 1,857 stores, 1,800 stores, 1,900, and look here, 3,579 stores. So the jump from 1.9 to 3.5 thousand. So they added instantly how many stores here? It's nearly 1.6 thousand stores, and the debt appeared. So we can straight away kind of understand that they borrowed this money to buy those stores. Okay, and Nick, probably you're right. They bought the company, maybe Zale. I'm not sure which one they bought, but that's the thing. Okay, so and then they start paying it off. Okay, okay. So now, based on that question, is it a good buy? Like, no, is it a good debt or bad debt? When the company borrowing to expand. Yeah, that's good. That's good. Okay, but then again, we need to look at a few parameters. First parameter is total debt level. When this Value Line report was, look at this, the total level of debt is $1.6 billion. And the total capitalization of the company at that specific time was 3.7 billion. Now it's probably $3 billion because the price dropped nearly 20%. Okay, so it's probably about $3 billion in capitalization. So the debt is more than 50%, total debt. The question, is it a good or bad thing to have debt that high? What do you think? Bad. Yeah, bad to have too much. So when we see that level of debt, we need to ask the question, is it manageable? First of all, okay, because if the company is uh, have to pay it off quickly, it's kind of dangerous thing. And especially what was dangerous here, look at this, long-term debt is 705 million. So it means that nearly 900 million, it's current debt. So the debt which they have to pay within a year, okay, and we can see that their net profit per year, it's about 570 million. So we understand that it's not good thing to have it when you have like 900 million in debt which you have to pay, and your income level is about 570 million. But again, remember, their cash flow much higher. So cash flow probably would be about 800 million here. Okay, so they probably would be able to easily to pay that debt. And now asking the question why the company dropped down in price, and we're going to look at this again, but the main reason, there were three main reasons why the company dropped in price from $150 to nearly $46 at one point last year. Now, first of all, it was a general downturn in retail industry. People were exiting any retail company, regardless if that company was making money or losing money, they still were exiting this company. And we discussed more than probably dozen companies during last year, and some of them, they moved quite a lot. Like when we analyzed Signet, we analyzed course. I don't know who had course, guys from you, but it jumped quite a lot. At least whoever invested probably made about 60% return already, and it's nearly 6-7 months passed since the masterclass we had with you. So, and some company like Buckle, during last 2 months, it's moved from $13 to nearly $23. So about 80% within 2 months growth. BBBY moved about 30% probably, something like that within the last 2 months. Quite other, Foot Locker jumped a lot, right? That's company completely took it from the market. Okay, so some companies, they move quite good in retail in the last few months, but before that they were dropping like nice, and Signet was one of them. Another bad reason, another reason which affected the price fall, it was a court case. Management of Signet Jewelers was sued for harassment, and when they announced it, I remember when this went public, this information, the share price dropped on a day quite a lot. And it was like based on the news which they come up, I thought it was sexual harassment because they said it in this wording. But when I started reading it in more details, I realized it's nothing related to sexual harassment. It was more like sex discrimination. Some women, they kind of try to sue the company that women have less opportunities in the company. So company presented all facts that I think something like 80% of like people who work in the company, they're females. And when they presented all facts, court dismissed the case and management won. So they didn't have any proceedings since that. So it was a second reason why the company dropped in price, kind of news about the court, even they won and there wasn't any penalties regarding that. And the third reason was, we'll come back now in a second, it was a kind of too much credit sales. They were selling quite a lot of products in credit, and we're going to have a look in a second how much they did, like sales they had. Okay, another thing which I just to cover here before we move to another one, and it's just return on total capital and return on share equity. We can see that it's on total capital, so it's including the 13%, and on share equity, it's 15.5%. So it's not bad, it's quite good. So I mean, if your interest rate and you're paying you borrowed all this money and you're paying, let's say, about 3% annual interest, and you're making 15% by investing this capital, so it's quite good. It means that your debt is working for you. Okay, so that's kind of, if your interest payment would be 5%, and your return on share equity or total capital would be 2%, that would be the bad thing. Okay, so you have to get rid of that. So in this particular case, it's quite good return in this particular case, and we can see that dividends growth as well here, quite nice. Okay, so that's. Do you have any guys questions regarding that part, or all clear on this specific? So put pluses if it is all clear. Okay, great. Okay, continue. Okay, that's where the interesting part starts. So we can see it operates about 3,600 stores. It has 3 major divisions. Okay, and like altogether they have much more companies, brands which they sell. But that's what I wanted to show you. Okay, so in current situation position, they have cash, about 100 million in cash. And then look at this receivables. So just wanted to ask you guys, do you know what receivables like are? Put minus who don't know, who doesn't know what it is. I'll explain. Okay, receivables, they're placed in assets. In reality, when you sell something, when you sell the product, but people didn't pay you yet for this product, they owe you that product. But you already create the sales. You're already showing to the tax office that you made this money. Okay, it's like your asset already. It's like cash. But in reality, you don't have this cash. It's still in the hands of your client. And the main concern here is that client going to pay you or not. If that client is paying you, that's fine. It's no problem. But if that client, for whatever reason, like defaulted on payment, stopped paying you, it means that this $1.7 billion, if all clients, they decide not to pay Signet, that's become like, so like loss. They will have to deduct it from the company. And now imagine, I just told you that the total capitalization of the company right now is $3 billion, and $1.7 billion is in somebody's hands. Do you think it's a good thing or not? Definitely not. So it's not. And that was the third reason why the company went down quite a lot, because investors, they weren't happy that the company was providing this type of credit sales. Company had internal, within the company, credit facilities. So they had to borrow money from the bank in order to provide the credit to their clients. Okay, so that's kind of the operator. And you understand that creates certain risks. It's definitely increase your sales level because more people will buy your products, but in the long term, it might affect you. For example, if some kind of economical downturn and people lose their job, they probably fail to pay. Okay, so this is kind of stuff which you have to take attention. And actually, based on that, related, why I paying attention too much to receivables, because the last fall actually related to that specific problem. Okay, and we're going to just discover it. But when we look at this, if you just calculate the ratio current assets to current liabilities, it's actually very good ratio will be here, because $4.3 billion in assets and $1.8 billion in liabilities. But when you look at this, it's $2.2 it's inventory, okay, and $1.7 it's receivables. It's great if they can pay it straight away, but if not, so company can be in trouble here. Okay, so that's important. Okay, you remember that. Now, if we look at the earning and sales growth rate, so we can see that sales growth was 15.5% in average during last 5 years, and the earning rates were 20%. So we already noticed it, that earnings are growing faster than sales. It's good, and book value was growing 9.5%. Now, but value line, for whatever reason, they put it here 6.5% sales growth and 2% on the growth in earnings, which is kind of strange based on previous kind of history of the company. I don't know why they are putting that stuff, because I didn't really hear anything bad within a company specific itself that they're having no growth during next 5 years. Okay, they're actually doing a lot of restructuring right now within the company in order to provide those sales. Okay, that's clear. Another thing which I wanted to pay attention is that they have seasonality, definitely seasonality. We can see that the worst quarter is this one. You can see, and the best quarter is this one. And you probably understand why, right? Because people buying presents to their loved one just before Christmas, just before New Year. So that's the specific quarter which is going on right now. So that's where they make majority of the money. Okay, and the previous quarter where they make less money, okay, the sales money. So this is kind of important thing to understand. All right, now what was going on within the company recently? The company purchased Air2Net, okay, company, and the major reason for that, they decided to improve. Okay, Jonas, we'll get to that point. So that's why at the moment we're in discussion, because we see good points, we see bad points, and for us it's important to understand what's happening right now. Okay, so why is like that happening? Why the sales level dropped? Why the earnings dropped? Okay, why the share price collapsed like that? So we need to understand that. And at the moment, we're going to exactly to look what is going on within the company specifically. Now, if you look at their sales level, you will see that company had only 3%, like previous quarter before that, not the last quarter before that, they had about 3% in sales online. The rest of it, 97% offline. So guys, do you think it's a good ratio or bad ratio? Bad, because at the moment more and more companies, they are focusing on online sales, and Signet definitely kind of lost in that. But then again, I just discussed with some ladies and asked them, how would you buy jewelry online? And only one girl out of 10 told that she would, and 9 told no, definitely not, we're going to look at this. We're going to go to the store, we're going to look at this because we want to see it better than online. And if you read last report, you will see that actually Signet Jewelers increased their online sales nearly 60% during last quarter. Why? Because they purchased this company and they like invested a lot in online sales. So now they're improving and they're doing a lot of work in order to sell their products online, because they're not only like diamond store, they're also selling silver kind of, you know, sterling jewelers. So kind of they can, and I presume more people would buy some kind of in a range of $70 to $500 they can easily buy online. It's one thing. So they're investing in IT technology. But secondly, what they did, they actually built up the photo center, and now they're going to like shoot photographs for all these diamond products in order for clients, when they buy online, to see 40 times like size, like they can increase in size jewelry 40 times. And I presume that's probably even better in my case. Like, I mean, it's much better than to see the diamond in the shop, because if people, especially with a poor eyesight, they probably cannot increase the, you know, and see it 40 times bigger. So you can see the quality and check the quality before they purchase the product. Secondly, what they do about online sales, they developing the app. I actually tried to find this app. I thought maybe it's already developed, and I tried to find it. I couldn't find it on their website, so it's probably still in the process. But the idea is that they're trying to develop an app for smartphones that you can put your hand somehow, and you can see how jewelry, like your ring, is going to look on your finger. Don't know how it's going to work, but that's what they're trying to do. So you can try your ring without actually going visit to the shop. If it's going to be fine and nice, I presume it's definitely will increase their sales level, online sales level. Okay, so that's kind of things. So I definitely can tell that management of that specific company is moving to that direction. They are doing a lot of work. They invest in a lot of stuff. They bought this company. I think they paid about $300 something million for that specific, or that's $328 million in cash for this specific platform. Okay, so they're going to improve it. So I presume in the next quarters, we definitely will see improvements in sales related to online. And I presume it actually will help to have higher margin, because like when you sell online, you save a lot of money on store, on staff, and some other things. Okay, that's related to sales level of online. So they're improving this part. Okay, the second thing is based on that high level of receivables and credit sales. 2 quarters ago, they made a decision that they're going to switch. Actually, they made a decision earlier, not 2 quarters ago, but 2 quarters ago, they announced that they're going to do it right now at that specific time. So they're going to implement changes. So they found a partner, joint venture partner, another financial organization, which is going to provide all credits for their clients. So instead of giving credits themselves, they're going to provide credits from their partner, financial organization. So, and that's what happened during last quarter, and that's why sales were affected. Because when you read the reports, they expected that during 1 quarter they were going to transfer whole their IT system from providing internal credits to external credits, but they didn't manage to do that. It's one thing. So it took longer than they expected. Secondly, they had a lot of issues with that IT system, and quite a lot of times they had to spend hours on the phone with customer support from that financial organization in order to solve like IT issues and credit issues and whatever, you know, and it's affected the sales level. And if you look why they started doing last quarter, actually, I believe they chose the right moment, but they didn't work as effectively as they could, because look, they chose the quarter where they had the minimum sales. They didn't want to, and they had this quarter, they wanted to have the system ready for the big sales. Okay, that's why they started doing it here, but they didn't manage to do it. And that's the problem. And that's actually what affected the sales, because they come up and they said, look guys, we had a lot of issues with IT transactions and we didn't manage to complete it, and we're going to continue it during next quarter. And they're planning to complete it fully in the next quarter. They devote more staff to do that. They hired more people, like IT experts in this area, who are doing it right now. Every time when they have an issue, they're trying to work on it, that it's not appearing again in the future, but it's still going to affect the sales. And it's going to affect the biggest quarter they usually have. As a result, okay, what they did, actually going to show you this. Look at this. They estimated, okay, somewhere from 10 cents, and they made 0.15 cents in profit. So when they announced the earnings, they were in line. Like, they actually did better than expected. So the question is why the share price collapsed when the company made same amount of money as promised, even more. The reason for big fall, because they told that this number is going to be less. If we'll go back to value line and we look at there, value line tells us that they're going to make $7.10 in profit this year. Signet had previously the range between $7.10 to $7.9 in profit. So somewhere value line is more conservative regarding that. So, but Signet now, they reduce this level to $6.1 to $6.9. So they told that they're going to make $1 less. And the problem why, the main reason why they changed their earnings, because of these transactions, okay, because their IT like credit transaction took longer than I expected, and it's going to affect their best quarter. Now, as a result, the share price collapsed. Now, the question, guys, for you, is that problem going to stay there forever, or is it going to go away? What happens in 2 quarters? What do you think? And I'm going to show already what are they going to sell at that book. It's temporary, definitely. So we always, when we analyze the company and we see this drop, we analyze the reason and we try to understand, is it temporary or is it permanent problem? Okay, how long effect? So first of all, I'd say, are they doing the right thing? Are they doing the right thing that they get rid of, like they eliminating this type of receivables level? Is it a good thing? It's definitely a good thing, right? So they're not going to take care, they are not going to have this risk that people fail their companies. They transferring the risk to another company who are experts in this. So that, yes, absolutely, Dory, they're making somebody else problem. But it took longer than expected. That's no, it's not the expertise, right, to make this IT transaction. So, and a lot of companies, when they're trying to do it, they overestimate themselves. But at least the good thing, they anticipated this. They predicted it in a correct way, and they made more even they promised. At the moment, they put lower number, and the price already reflects that number. It's already dropped based on that. Now, if we look at the earnings predictability, it's 85%. So 8 out of, let's say, 8.5 times out of 10 times, they always right. And then 1.5 times, they're not right. And last time they weren't right, but they made more. They promised one amount and they made more than promised. So the question is, right, so are they over delivering or under delivering? And we can see, like, if you look here, it's very close all the time. Here it's under delivered a bit, right? So the drop. But in reality, they, like previous calls, here it's over delivered. Here it's exactly the same. Here over delivered. Tiny, but about the same. So that's why we can tell that the company is doing definitely right thing. They reducing their risk. They get rid of the problem. Okay, and yes, it took longer than anticipated. It's affected the price, but probably that's a good thing for us as investors, because now we can pick the stock much cheaper, right, than like a month ago. Now the question is, I wanted to ask you, if the company is making $6.1 this year, and the share price is right now $52, what's the PE ratio for that? Who can calculate it? About 8, to be exact. Yeah, 8. So 8, and the index PE is 25. What happened to this company? Like, they were growing, like sales growing for the last 5 years, earnings growing for the last 5 years. They investing in online sales, they improving online sales. They definitely do right things. Yes, they didn't do it earlier, which is bad, but now they're doing it. Okay, they had credit sales a lot. They were successful. Now they're transferring it to another company. They, as Dory said, they make it someone else's problem, not their own problem. So it seems like management is doing really, really good stuff, and they're buying shares when they are lower price. So the question is for you guys: do you think it is like, based on the quality and price analysis? What can you tell? Is it a good company? Is it undervalued or overvalued company? How can you say, like, by numbers would say, in a quality sense, and then on the price level? What would you say? Gina, definitely undervalued. Yeah, good is what? Good is undervalued, overvalued. Good company or bad company? Put numbers. You know numbers. 52 is the best, 0 is the worst. So yeah, definitely can tell that it is undervalued, right? everyone is telling undervalued. Now, and the good as well. Okay, let's have a look what fundamentally, okay, price is low. Okay, Nick is great.